Hello, Rick Komarek, Certified Financial Planner, coming at you with a brand new article that just came out this month called The Randomness of Global Equity Returns. This comes from our friends over at Dimensional, so let's dive right in and take a look. Investment opportunities exist all around the globe. There are more than 40 countries with over 15,000 publicly traded companies. That's pretty impressive that all of these trades are going on for each company across the globe pretty much on a daily basis. It can be a little daunting for some investors to try and pick out, which ones are going to be the best. And so what a lot of times investors will do is they'll stick to the companies that are in their own country, their own what's called a home market or home bias. And there can be good reason for that, such as tax benefits, for example. However, let's consider Australia. If they only focused on their home country, that would represent about 2% of the global equity market. Or put another way, they would be missing out on 98% of all of the global equity returns that are available out there. So let's take a look and see what the history of the different countries are over the past 20 years. And that's what these two charts show. And each of the colors in those charts represent a country. And each year, the best country is put at the top and the worst down at the bottom. And what you can see just on a visual basis here is that it's completely random. Whichever one was best, in one year could be the worst in the next year or somewhere in between. So let's consider the performance of US and Denmark as illustrating this. Who did best over that time frame? If we look at the chart here between the United States in the dark blue and then Denmark in the gray, it's pretty random. You can't really tell who did better or who did worse. But if we actually look at the numbers, it turns out that Denmark did the best over the last 20 years with 9.1%. And the US, although having some strong returns in the most recent years, had an annualized return of 4.9% in the last 20 years. Bear in mind that Denmark represents less than 1% of a global market cap available to investors. However, just because they did the best overall in the past doesn't mean that they'll do the best in the future. So, for example, in any one given year, they could move from first to worst. Consider that they posted the highest return in 2015. However, the next year, in 2016, they posted the lowest return. Or consider New Zealand in 2000, they had the lowest return, but then in the next 2 years, they produced the highest returns. So it's a random effect on which country will do the best. And in any one given year, there could be a big difference between the best and the worst. For example, Norway produced as high a return as 87% and Japan as low as 6%. So that's an 81% difference between the two. So now the good news. There is evidence of randomness in these global returns, though, and it's not all bad news. Rather than trying to guess which country will outperform, investors committed to a well-structured, globally diversified portfolio are better positioned to capture the performance of the global equity markets where and when they occur. If you have any questions about globally diversified investing, retirement, taxes, insurance, feel free to reach out to me anytime.